Welcome to the Deep Dive, where we aim to cut through the noise, get you truly well-informed, maybe offer a few surprising facts, and, well, just enough humor to keep you hooked.
Hopefully.
Now, when we think about Canada's big six banks, certain words usually pop up, don't they? Stability, maybe a bit conservative.
Dependable.
Right, and definitely domestic powerhouses. But what if one of them is kind of quietly undergoing this really radical transformation, something that challenges its very identity?
Yeah, it's not every day you see an institution of that size, woven into the Canadian financial fabric, decide to make such a fundamental change.
Especially when its identity has been tied to one specific thing for, like, over a century.
Exactly. That's the kind of thing that really makes you sit up and take notice.
Absolutely. So today we're focusing squarely on the Bank of Nova Scotia, or, as pretty much everyone knows it, Scotiabank.
Right.
For generations, they've proudly flown the flag of Canada's most international bank. That wasn't just marketing fluff, was it? It was core to their strategy, their brand.
No, it was absolutely central. Their extensive global footprint, especially in Latin America, really set them apart from the other Canadian banks for decades.
But that story, as you said, is now hitting a really critical inflection point.
It really is.
Yeah.
Our deep dive today comes from an in-depth investment analysis report, and it shows Scotiabank is orchestrating a pretty significant strategic pivot.
Under new leadership, too.
Yes, under new leadership. They're actively shifting away from that broad international focus to prioritize what they're calling the North American corridor.
So Canada, the U.S., and Mexico.
Exactly. It's a major reorientation of capital, of strategy, of where they see their future growth coming from.
So our mission today is really to unpack why. Why this dramatic shift now? What does it actually mean for the bank's future?
And what should you, our listener, whether you're just curious about big corporate strategy shifts or maybe even looking at this from an investment angle?
Right. What should you understand about the opportunities this creates and, let's be honest, the risks involved? Because this isn't just about spreadsheets and financial ratios, is it? It's a fascinating story. A huge company trying to redefine itself in a really complex, fast-changing, global financial world.
It's like watching a strategic playbook being rewritten in real time. And it touches on so many things: geopolitics, trade deals like the USMCA, the speed of digital change, shifting customer needs across three really diverse but increasingly linked economies.
It's definitely a multi-layered story we're getting into today. All right, let's start peeling back those layers. To really get where Scotiabank is going, we need to appreciate where it came from, that heritage, the story behind that title. Canada's most international bank.
Yeah, you absolutely have to understand the roots to grasp the significance of this pivot. Scotiabank wasn't founded in Toronto, actually. It started way back in 1832 in Halifax, Nova Scotia.
Halifax, right. And its purpose then was pretty specific.
Very. It was initially set up to facilitate transatlantic trade. Think about it, early 19th century, ships carrying timber, fish, agricultural goods from Nova Scotia to Europe.
And bringing back manufactured goods.
Exactly. Scotiabank stepped in to provide the financial grease for those wheels, letters of credit, foreign exchange, loans for merchants. Its birth was inherently linked to international commerce.
So it wasn't just a local bank from day one.
Not at all, and it grew quickly. By 1900, it had moved its headquarters to Toronto, right into the heart of Canada's financial center.
But there's this one move even before that, back in 1889, that just seems so pivotal for that international identity. The Jamaica branch.
Ah, yes, Kingston, Jamaica, 1889. That was a huge deal. Monumental, really. It was the first time any Canadian bank had opened a branch outside of the U.S. or the U.K.
Wow. Okay, so not just following the flag, so to speak.
Not at all. It signaled a real willingness to go into what were seen then as, well, more exotic, maybe riskier markets. They were actively seeking growth opportunities in developing economies.
And that really set the stage, didn't it? That became part of their DNA.
Absolutely. That early expansionist mindset, that willingness to look beyond Canada's borders, defined them for over a century. It wasn't an accident. It was a core characteristic.
And that DNA fueled growth for decades. But it wasn't just opening new branches, right? Acquisitions were key, too.
Oh, hugely important. Growth came organically, yes, but also through very strategic, calculated acquisitions that built out specific capabilities or expanded their geographic reach.
Like McLeod Young Weir.
Exactly. 1988, they bought McLeod Young Weir. That wasn't just adding assets. It was a deliberate move to build a serious capital markets division. That became Scotia McLeod, a major player in investment banking and wealth management.
And then the move into Latin America, solidifying that international focus.
Right. Early 2000s, acquiring Grupo Financiero Inverlat in Mexico. That was a cornerstone acquisition that gave them a really strong foothold in a key, fast-growing Latin American market.
And closer to home, ING Direct Canada.
Yes,
Yeah.
which they rebranded as Tangerine. That was quite forward-looking, actually. It gave them a leading digital-first bank, tapping into the shift to online banking well before some peers really embraced it.
So these weren't random moves. They show adaptability, foresight, building towards the scale they have today.
Definitely. It was a deliberate, long-term strategy that built the most international bank reputation.
So fast forward to today. Give us the snapshot. Where does Scotiabank stand now globally?
Well, it's still firmly one of Canada's big six, a globally significant player. We're talking about $1.4 trillion in assets, roughly, serving over 25 million clients around the world.
And that international concentration is still primarily Latin America.
Very much so. They have this incredible 150-year history in markets like Mexico, Chile, Peru, Colombia, the Pacific Alliance countries. They hold significant market share there, deep local roots.
Plus the Caribbean.
Right, a big Caribbean network too, over 200 branches,
Right.
often a really crucial part of the financial system in those island nations.
And this is what makes Scotiabank so different from the other big six, isn't it? Because their international focus tends to be
The U.S., predominantly the United States. Think RBC with City National, TD with its huge U.S. retail presence, BMO with Bank of the West. Scotiabank, for a very long time, chose a different, more geographically diverse international path.
which offered unique growth, but as we'll see, also brought unique challenges.
Exactly. Both sides of the coin. And to really understand how this all works and why the pivot is happening, we need to look at how they structure the business. There are four main segments, or pillars, as they call them.
Right, the revenue engines. Let's break those down. First up, the bedrock. Canadian banking.
Yeah, Canadian banking is, without a doubt, the largest, most stable, and crucially, most profitable segment for Scotiabank. It covers everything retail banking for individuals, services for small businesses, lending to large commercial clients, all right here in Canada.
And the numbers reflect that strength.
Absolutely. Fiscal year 2024, this segment pulled in adjusted earnings of $4.28 billion. That was up a healthy 7% year over year, driven by good growth in loans and deposits and managing their margins well.
So this is the anchor, the high return engine funding everything else.
It's the foundation. Consistent cash flow, reliable profits, and a vital source of stable, low-cost funding for the entire bank.
Okay, then pillar two, international banking, the historical differentiator.
Exactly. This is what made Scotiabank unique for so long. Focused mainly on those high-growth potential markets in the Pacific Alliance, Mexico, Peru, Chile, Colombia, plus that extensive Caribbean network.
Lots of long-term potential there, demographically, economically.
For sure. And it performed well in fiscal 2024, too, generating adjusted earnings of $2.86 billion, up a strong 11%. But then this is the critical point for the pivot.
Here it comes.
While it offered that growth potential, this segment has historically carried higher economic and political risk. And most importantly, it generated significantly lower returns on the capital invested compared to the Canadian banking segment.
Ah, the profitability gap.
That's it. A persistent gap. Offering growth, yes, but not as profitably as the domestic business. That's a core part of the story here.
A huge distinction, and you can see why leadership might start rethinking things. Okay, pillar three, global wealth management. Feels like a different beast.
It is, in many ways.
Yeah.
Global wealth management is what we call a capital-light, fee-oriented business. It doesn't need as much capital tied up to generate revenue compared to lending. And its earnings aren't as directly tied to interest rate swings.
So, more stable, potentially higher margins.
Generally, yes. It offers comprehensive wealth advice and solutions to clients in Canada and about 13 international markets. It's seen as a key growth engine because of those attractive characteristics. Fiscal 2024, it brought in $1.61 billion in adjusted earnings, up 10%. Assets under management, AUM, hit $373 billion.
So banks love these fee-based businesses. Less capital-intensive, good diversification.
Absolutely. Very attractive growth area.
And the final pillar, global banking and markets, or GBM, the wholesale side.
Right. This is the investment banking and capital markets arm, serving large corporations, governments, institutional investors globally. Think corporate lending, M&A advisory, sales, and trading in financial markets.
Connecting the bank to the big leagues.
Pretty much. Facilitating large-scale financing, connecting international clients to Canada, and vice versa. For fiscal 2024, GBM reported earnings of $1.69 billion. It's plugged into those big economic trends.
Okay, so those four pillars really map out the bank. But especially that contrast between Canadian and international banking profitability that really sets the stage for understanding this pivot.
It lays the groundwork perfectly.
But beyond these core segments, Scotiabank has some other really interesting strategic assets, right? Things that add to the picture.
They definitely do. Several key subsidiaries and partnerships are really important. First, there's Tangerine Bank, wholly owned digital-first bank here in Canada.
The one they bought from ING.
That's the one. It operates with a much lower cost structure. No big branch network. So it's really effective at attracting younger, tech-savvy customers and driving digital innovation. It's more agile.
And then there's that loyalty program, Scene Plus Sci. That's become a bigger deal recently.
Much bigger. Scene Plus isn't just a Scotiabank program anymore. It's a major strategic partnership with Empire Company, the parent of Sobeys, Safeway, IGA, and other stores.
So groceries and banking points.
Exactly. They've added over 4 million new members since that partnership launched. It creates this huge ecosystem. It's not just about earning points. It's a powerful tool for acquiring new customers, deepening relationships by offering relevant rewards, and creating opportunities to cross-sell Scotiabank products like credit cards or mortgages.
Okay, and this next one feels like it connects directly to the new strategy, especially the U.S. part. The KeyCorp investment.
Yes, the KeyCorp investment is absolutely pivotal. A very recent major strategic move announced in August 2024. Scotiabank bought a 14.9% equity stake in KeyCorp.
Which is a big U.S. regional bank, right?
Yeah. Yes, based in Cleveland. Around U.S. $187 billion in assets. This isn't just a portfolio investment. It's a clear signal, a cornerstone of their renewed push into the crucial U.S. market.
And the way they did it, a minority stake, not a full takeover, that seems significant too.
Very significant and strategically quite prudent. Instead of a massive, complex, and potentially very risky full acquisition, which can get bogged down in integration issues and huge capital costs, taking a minority stake gives them immediate exposure to the U.S. market.
And it adds to earnings right away.
Yes, it's earnings accretive immediately. But without the full operational headache or capital outlay of buying the whole thing, management talks about future optionality. Meaning it opens the door for deeper partnerships later, maybe joint ventures in certain areas like corporate banking or wealth management, or even a full takeover down the road if it makes sense. And the initial relationship works well. It minimizes the upfront risk and lets them learn the market.
A smart, measured step into a key strategic market. Okay, that really sets the scene for the pivot itself. So with that foundation, let's dive into the pivot itself, part 2. The strategic pivot, redefining Scotiabank's future. This feels like a genuinely bold move for such an established institution.
It really is. And the reason why they're doing it, the genesis, comes down to a problem the market had been highlighting for years. Scotiabank's stock valuation consistently lagged its big six peers.
Okay, the market wasn't giving them full credit. Why?
Largely because of the lower profitability and the higher perceived risk tied to those extensive international operations, especially when you compare them directly to the powerhouse Canadian banking division.
So the market was essentially sending a signal, a performance gap signal.
A very clear signal. The numbers were pretty stark. You look at return on equity, ROE, that key measure of profitability for shareholders. In their international segment, it was running around 12.8%.
Okay.
Compare that to the Canadian banking division, which was delivering almost 30% ROE, 29.7%.
Wow, that's not a small difference.
Not at all. More than double. That massive gap acted as a persistent drag on the bank's overall consolidated returns. And that directly contributed to the lower valuation multiple the stock traded at compared to peers.
So for the new CEO, Scott Thompson, who came in February 2023, fixing this wasn't just about growth, it was about profitable growth.
Exactly. Profitable growth and improving shareholder returns across the whole bank. That's the core problem this pivot is designed to solve.
Makes perfect sense. So what is the new vision, this North American corridor strategy? What does it actually involve?
This new vision, driven by Thompson, fundamentally shifts where Scotiabank is putting its money, its capital. It's moving to a much more geographically concentrated footprint.
Concentrated where?
The bank has explicitly stated its plan. Direct approximately 90% of its incremental capital. That's the new money being deployed for growth into the high return perceived lower risk markets of Canada, the U.S., and Mexico.
90%, that's a massive reallocation.
It's a huge reorientation of strategic focus and investment dollars.
So this North American corridor, what does that mean in practice? How does it tie into things like trade agreements and supply chains?
Well, the strategy is explicitly designed to tap into the growing economic integration under the USMCA trade agreement, the successor to NAFTA. We're seeing big trends like nearshoring.
Companies moving manufacturing closer, maybe from Asia back to North America.
Exactly. Closer to their main consumer markets.
Right.
That means more goods, services, and capital flowing across the borders between Canada, the U.S., and Mexico. More demand for integrated financial services, cross-border payments, trade finance, treasury management.
So Scotiabank already having a presence in all three.
Right. They aim to be the go-to bank for businesses operating within that corridor, leveraging their unique footprint. The clear goal is improve overall profitability, fix the capital deployment issues of the past, and ultimately close that valuation gap with their peers. This integrated North American play is absolutely central to the investment thesis now.
And the cornerstone of the U.S. piece of that strategy, as we mentioned, is KeyCorp. Let's unpack that investment a bit more. Seems very deliberate.
It is. Announced August 2024, that 14.9% stake in KeyCorp for US $2.8 billion. The way they did it is key. A minority stake, not a full, messy takeover.
Why is that approach better, do you think?
Well, it avoids the massive complexity, the integration risks, the culture clashes, the huge capital outlay of buying a whole U.S. bank outright right now. This way, they get immediate exposure to the lucrative U.S. market. It starts adding to their earnings per share right away.
Without the operational burden.
Exactly.
Yeah.
And it creates that future optionality we talked about. Maybe deeper partnerships later, maybe specific joint ventures, maybe even a full takeover eventually if things go well. It's a much more measured, adaptable, capital-efficient way to re-enter the U.S. market in a meaningful way.
Testing the waters before diving in headfirst makes sense, especially given past international experiences.
Precisely.
But while they're doing this selective international expansion in the U.S., they're also, as the analysis says, doubling down on Canada, right? Aiming for 50% of earnings growth from the domestic market.
Yes, absolutely. Alongside the international refocus, the core Canadian banking business is getting top priority. The goal is for it to drive about half of the entire bank's earnings growth going forward. That's a huge commitment to the whole market.
How are they going to achieve that in what's already a pretty mature, competitive Canadian market?
The strategy really centers on acquiring and, crucially, deepening relationships with what they call primary clients.
Define primary client again.
These are customers who have an active checking account with Scotiabank, plus at least one other key product like a credit card, a mortgage, an investment account.
And these clients are much more valuable.
According to Scotiabank's internal data, yes. They found these primary clients are twice as profitable and 5 times more loyal, 5 times less likely to switch banks than other customer segments. So it's about quality of relationship, not just quantity of customers.
Okay, so how are they going after these primary clients specifically? What are the initiatives?
Several key things. They're really leveraging that expanded Scene Plus loyalty program with Empire. That's a massive customer acquisition tool offering tangible rewards, and it gives them data to cross-sell relevant products effectively.
Using points to build loyalty and sell more.
Basically, yes. They're also pushing to unlock the full potential of Tangerine, their digital bank, grow its customer base using its low-cost, high-satisfaction model, and expand the products it offers beyond just savings accounts, things like credit cards, loans, simple investments.
Getting more revenue from Tangerine customers.
Right. And they're using strategic product bundles. They mentioned Mortgage Plus bundles. The idea is when someone gets a mortgage, often the first big product they get with a bank, immediately bundle it with other useful products and services.
Make them stickier from day one.
Exactly. Increase that customer stickiness and lifetime value right from the start. So even in a mature market like Canada, the focus is on deepening those relationships and turning casual customers into these highly profitable primary clients.
That strong domestic base is definitely a crucial anchor, especially if there's volatility elsewhere. But none of this happens efficiently without a serious digital engine, right?
Oh, absolutely not. Digital transformation is critical, maybe the critical enabler for this whole strategy. It's about improving the customer experience, yes, but also driving massive operational efficiency behind the scenes.
So what are they investing in specifically?
Big investments in end-to-end digitization, automating processes from start to finish, cutting out manual steps, reducing errors and delays, enhancing their data analytics capabilities to understand customers better and offer more personalized services, and forming strategic partnerships with tech leaders.
Yeah.
I mentioned Google Cloud and NVIDIA.
Wow, those are heavy hitters. What's the goal with partnerships like that?
It's about leveraging cutting-edge AI, machine learning, and cloud infrastructure. The day-to-day goals are tangible. Increase the volume of sales happening through digital channels, achieve higher rates of straight-through processing, where transactions go through automatically without human intervention, which lowers costs significantly, and ultimately deliver a seamless experience, whether a customer is using the app, the website, or walking into a branch.
How are they doing on that front? Are customers noticing?
They've reported good progress, a 17% increase in digital adoption since fiscal 2020. That's positive. However, it's worth noting that some external reviews, like a 2025 Servisker ranking, still place Scotiabank's online banking experience behind leaders like TD, CIBC, and RBC. Tied for sixth, actually.
Okay, so progress, but still room to improve to catch the leaders on the customer-facing side.
Exactly. It suggests that while they're making big strides on the back-end technology, the journey to really differentiate and lead on the front-end user experience is ongoing. A key focus area for sure.
A digital marathon, not a sprint. Makes sense. So how do the other two segments, global wealth management and global banking and markets, fit into this North American focus?
They're definitely part of it and crucial for diversified growth. Global wealth management, being capital light and fee heavy, is a really attractive growth area. The focus there is evolving their total wealth advice model in Canada for high net worth clients, and also expanding selectively in international markets that align with a new strategy where they see good growth potential.
And international wealth has been growing well.
Very well. It showed strong 19% earnings growth in fiscal 2023, highlighting the potential there.
And GBM, the wholesale side, is it also narrowing its focus to North America?
Increasingly, yes. It's aligning more with the North American corridor strategy, leveraging its expertise in key sectors like technology, digital infrastructure, sustainable finance to serve corporate and institutional clients across that integrated Canada, U.S., Mexico market.
So helping businesses operating across those borders.
Precisely. Growing the U.S. GBM business in particular is a central objective.
Yeah.
Tapping into those increased cross-border trade and investment flows we talked about, driven by USMCA and nearshoring. So these segments aren't just operating in silos, they actively support and benefit from the broader North American corridor strategy.
Okay, this pivot is happening within a very specific context, the Canadian banking industry. Let's get into part 3, industry landscape and Scotiabank's place within it. Canada's system is often called an oligopoly, right? Stable, but maybe not the most competitive.
That's a fair description, and it definitely has pros and cons. The big six banks, RBC, TD, Scotiabank, BMO, CIBC, and National Bank absolutely dominate.
Yeah.
Together, they hold something like 93% of the country's banking assets. It's incredibly concentrated.
And the upside of that is stability.
Undeniably. This structure contributes massively to the system's resilience. Canadian banks famously sailed through the 2008 global financial crisis without needing bailouts and navigated the pandemic shock relatively well, too. It's seen as a bedrock of stability for the Canadian economy. Strong regulation plays a huge part, too, of course.
But the flip side, that concentration must draw criticism.
Oh, constantly. Critics argue it limits true competition, potentially leading to higher fees for consumers, maybe less favorable terms on loans, and perhaps a slower pace of innovation compared to markets with more players. Consumer groups are often vocal about the lack of real choice.
So it's that classic trade-off, stability versus dynamism.
Exactly, a constant balancing act in policy debates.
And speaking of stability and regulation, banks operate under a very watchful eye, especially the big ones like Scotiabank, which is a DSIB, a domestic systemically important bank.
Yeah.
What are some of the recent regulatory pressures they're facing? Seems like it's always increasing.
It really does feel that way. The main regulator, OSFI, the Office of the Superintendent of Financial Institutions, its job is to protect depositors and ensure the banks are sound. And the rulebook is constantly getting thicker, adding complexity and cost.
Like the new climate risk rules.
Yes, Guideline B15 on climate risk management. That came into effect for the DSIBs like Scotiabank at the end of fiscal 2024. It's a big deal. It requires enhanced governance, new risk management frameworks, and extensive public disclosures about climate-related financial risks in their loan books and investments.
So banks now have to model climate change impacts.
Essentially, yes. assess the resilience of their borrowers to climate change, build new internal models, train staff on completely new risk types. It's a significant undertaking.
And it's not just climate, right? Regulation is broadening.
Definitely. OSFI's mandate has expanded. There's a new focus on integrity and security things, like protecting against foreign interference, beefing up cybersecurity against increasingly sophisticated threats, and then there's the whole move towards open banking, or consumer-driven banking, as Canada calls it.
Which means banks have to let customers share their data with fintechs.
Securely, yes. The forthcoming Consumer-Driven Banking Act will require banks to build the infrastructure for that secure data sharing with accredited third parties. That's meant to spur competition and innovation, but it requires massive tech investment by the banks to ensure privacy and security.
And operational resilience, too.
Right. A new framework demanding banks enhance their ability to prevent, respond to, and recover from major disruptions could be anything from a cyber attack to a natural disaster. It requires rigorous planning and scenario testing.
Wow. It sounds like a tidal wave of new compliance costs and a constant need for tech investment just to keep up with the rules, let alone compete.
That's exactly the challenge. This tightening environment drives up compliance costs significantly. It can also constrain certain business activities. And at the same time, banks have to pour money into technology just to meet these rules, plus invest even more to fend off nimble fintech competitors. It puts immense pressure on efficiency ratios.
The banks that can handle both compliance and innovation efficiently will have a real edge.
A huge competitive advantage, yes. Using technology smartly is key.
And then there's the macro environment interest rates. How does the Bank of Canada's policy impact Scotiabank's bottom line? It's a bit of a chess game, isn't it?
It really is. The Bank of Canada sets the target for the overnight rate, and that ripples through the whole system, affecting commercial banks' lending rates, bond yields, and critically, their net interest margins, or NIMs.
And rising rates are generally good for NIMs?
Generally, yes, at least initially. When rates go up, the interest banks earn on their assets, like loans, often reprices upwards faster than the interest they pay out on their liabilities, like customer deposits. So the spread, the NIM, widens.
But it's not always that simple, is it? There can be downsides even to rising rates.
Definitely not simple. That benefit can be muted if the yield curve inverts, meaning long-term rates fall below short-term rates, which squeezes banks borrowing short and lending long. Or if there's intense competition for deposits, forcing banks to raise their deposit rates quickly to keep funding.
And the big risk. What happens to borrowers when rates shoot up?
That's the crucial downside risk. Rapid or significant rate hikes increase the debt servicing costs for households and businesses with loans. If borrowers start struggling to make payments, that leads to higher loan delinquencies, higher provisions for credit losses for the bank, and that eats directly into profits. So it's a very delicate balancing act for banks managing their interest rate exposure.
Beyond rates and regulation, the whole industry is being reshaped by that massive shift to digital driven by customers and the disruption from fintechs. How big a deal is this for Scotiabank?
It's arguably the most profound long-term trend impacting them. Customers have fundamentally changed how they bank. In Canada, something like 77% of people now do most of their banking online or via mobile apps. Physical branch traffic is way down.
So banks have no choice but to invest massively in digital.
No choice at all. It's table stakes now. They have to make huge ongoing investments in technology just to stay relevant, meet customer expectations for seamless digital services, enhance the experience, and try to streamline their own operations.
And the fintechs and neobanks keep applying pressure.
Relentlessly. These agile players, often unburdened by legacy IT systems or costly branch networks, can target specific profitable niches, payments, foreign exchange, personal loans with slick user interfaces, and sometimes lower prices.
Forcing the big banks to react.
Exactly. It forces traditional banks like Scotiabank into this constant cycle. Innovate internally as fast as they can, acquire promising fintechs to bring their tech and talent in-house, or form strategic partnerships to leverage external capabilities. It's a race to adapt or risk losing valuable customer segments.
Okay, so within this landscape, the oligopoly, the tight regulation, the rate swings, the digital disruption, how does Scotiabank actually stack up against its peers? Where does it sit competitively?
Competitively, Scotiabank holds a solid position. But it's not always the leader in every category within Canada. In overall Canadian banking market share, it's around 13.4%. That puts it behind the giants, RBC and TD, but roughly on par with BMO.
Okay, and in wealth management?
In wealth management AUM, assets under management, it ranks fifth among the big six with about an 11.6% share. So definite room for growth there compared to the leaders. However, in global banking and markets, its investment banking arm, it's considered a very strong competitor, often highly ranked for things like M&A advisory in Canada.
What about its specific competitive advantages? What makes Scotiabank stand out, especially now with this new strategy?
A few key things. Owning Tangerine gives them that separate, powerful digital brand. Tangerine consistently scores well on customer satisfaction for mid-sized banks, and its digital focus allows for faster innovation.
And the Scene Plus program.
Yes, Scene Plus I, partnered with Empire, is a really valuable ecosystem. It's not just points. It's a customer acquisition engine and a way to deepen relationships across both banking and retail. That's quite unique.
But the biggest differentiator now is the strategy itself.
Arguably, yes, the North American corridor strategy. Scotiabank is the only Canadian bank with a significant scaled presence across all three key markets, Canada, the U.S., and Mexico. That integrated footprint is uniquely positioned to capitalize on that growing economic integration, the nearshoring trend within the USMCA bloc. Peers just don't have that same tri-country scale.
That historical depth in Latin America, even as they pivot, still contrasts sharply with peers focused mainly on the U.S. internationally.
It really does. It still offers exposure to those Pacific Alliance growth markets in a way the others don't. And brand-wise, Scotiabank is strong. Ranked the 6th most valuable Canadian brand overall, it scores well in J.D. Power surveys for retail banking advice, and MoneySense called it the best all-in-one bank.
So strong brand, unique footprint. But the challenge has been converting that into peer-leading profitability.
Exactly. Strong foundations, recognized brand, unique international history. But the persistent challenge and the reason for the pivot has been translating all that into consistently higher returns on equity. That's the nut they're trying to crack with this new strategy.
Right, let's get into the numbers, part 4. Financial performance, the story in the numbers. Because strategy is one thing, but ultimately, success or failure shows up here, right? On the income statement and balance sheet.
Absolutely. This is where the strategy meets reality. So for their fiscal year ending October 31st, 2024, Scotiabank reported total revenue of $33.67 billion. That was up a respectable 5% from the previous year.
Growth coming from where?
Pretty broad-based, actually. Canadian banking saw strong growth in net interest income. International banking and global wealth management also contributed to solid results. The one exception was global banking and markets, where softer capital markets activity globally led to lower net interest income in that segment.
Okay. And what about that crucial profitability metric, net interest margin, NIM? How did that look?
NIM for the full fiscal year 2024 was 2.16%. It did show some expansion, but the more interesting trend was into 2025. In Q3 2025, NEM reached 2.36%.
An improvement.
Yes, up 22 basis points compared to the same quarter of the previous year. They were clearly benefiting from that higher interest rate environment we discussed.
But you mentioned a challenge for Scotiabank here, historically funding mix.
Right. Historically, Scotiabank had a relatively high loan-to-deposit ratio. That meant they were more reliant on wholesale funding, borrowing from other institutions in the market, which tends to be more expensive and more sensitive to interest rate changes than stable, low-cost customer deposits.
So a core part of the new strategy is to change that funding mix.
Exactly.
Yeah.
A major goal is to grow that base of stable, low-cost deposits, especially from those primary clients they're targeting in Canada. That would significantly improve their NIM stability and profitability over the long run, making them less reliant on volatile market funding.
Makes sense. Now, shifting gears slightly, credit quality, provisions for credit losses, PCLs. Are loan losses rising, stabilizing? What's the picture?
PCLs, the money banks set aside for expected loan defaults, have been normalizing across the industry, moving up from the unusually low levels we saw during the pandemic. Scotiabank is no exception. Their PCL ratio for fiscal 2024 was 53 basis points, up from 44 BPs the year before, reflecting that tougher economic climate for borrowers.
But what about more recently, into 2025?
Trends seem to be stabilizing, which is interesting. The PCL ratio in Q3 2025 was 55 basis points, slightly higher, but the actual dollar amount of provisions taken that quarter was $1.04 billion. That was actually down significantly from the $1.4 billion they set aside in Q2.
What does that suggest?
It could suggest a few things. Maybe their earlier, more conservative provisioning is now proving adequate, or perhaps the most stressed parts of the loan book have already been identified and provided for. It's a positive sign, suggesting stabilization after a period of rising provisions. But PCLs are definitely a key metric to watch closely, as they reflect the health of the loan portfolio.
Okay, which brings us back to the core issue driving the pivot, that profitability gap. Return on equity, ROE, and return on assets, ROA. This really is central, isn't it?
It's absolutely the heart of the story. Profitability, especially measured by ROE, has been the persistent area where Scotiabank has lagged its top Canadian peers. Their adjusted ROE for fiscal 2024 was 11.3%.
And it improved slightly in Q3 2025?
Yes, it ticked up to 12.4% in Q3 2025. That's progress. But it still remains noticeably below competitors like RBC, which often operates closer to 15-16% ROE, or even CIBC around 14-15%.
And that gap is why the market values them lower.
Directly. This persistent profitability gap drives that valuation discount we talked about. It's the fundamental reason for this major strategic pivot. Their return on assets, ROA, around 0.57%, also trails peers, suggesting they're generating less profit from their asset base. The mandate from the market and the new leadership is clear. Close that gap.
So job number one for the strategy is boost that ROE. How are they doing on the cost side? Efficiency.
Cost management is definitely a huge focus for the new leadership team. The adjusted efficiency ratio, which measures costs as a percentage of revenue, so lower is better, showed improvement. It was 56.1% in fiscal 2024 and got down to 53.7% in Q3 2025.
That's moving in the right direction.
It is.
Yeah.
And management has set a pretty ambitious medium-term target to get that ratio down closer to 50%. That signals a real commitment to expense discipline. Historically, the international segment, with its dispersed operations, tended to be less efficient. So improving efficiency across the board, especially through digital transformation and streamlining, is crucial for boosting overall profitability.
Okay, let's talk capital allocation and shareholder returns. How are they balancing big strategic bets like KeyCorp with keeping shareholders happy, especially with that long dividend history?
It's a balancing act. Capital allocation is clearly being redefined, prioritizing those higher return North American opportunities like the KeyCorp investment shows. But Scotiabank also has this incredible dividend track record. They've paid dividends every single year since 1833.
Wow, since 1833. That's
Yeah.
commitment.
Incredible history. It underscores a deep commitment to returning capital to shareholders. And the dividend growth has been strong too, an 8.4% compound annual growth rate over the last 20 years.
And the current yield is pretty attractive for income investors.
Very attractive. As of August 2025, the forward dividend yield was around 5.59%. That's often among the highest of the big six. It's a core part of the stock's appeal, provides a solid income stream and some downside cushion while this strategy plays out.
And is the dividend sustainable? What's the payout ratio?
Yes, management keeps the payout ratio, the percentage of earnings paid out as dividends, within a target range of 40-50%. That's generally seen as sustainable, ensuring the dividend is well covered by profits and leaving enough capital for reinvestment in the business.
Do they also do share buybacks?
They do. They have an active share buyback program, a normal course issuer bid or NCIB. As of Q3 2025, they'd repurchased about 3.2 million shares under their current program. Buybacks return capital too, and also help boost earnings per share by reducing the share count. Shows management thinks the stock is good value.
And overall capital strength, are they well capitalized?
Very much so. Their Common Equity Tier 1, or CET1, ratio is 13.3% as of Q3 2025. That's comfortably above the minimum, 11.5%, required by OSFI for banks of their importance. This strong capital cushion gives them a lot of financial flexibility for strategic moves and protects them against economic shocks.
So strong capital, committed to dividends, but reallocating for growth. What about the overall balance sheet?
Total assets were around $1.42 trillion as of Q2 2025. And as we discussed, a key focus in managing that balance sheet is improving the funding mix, growing those stable, low-cost core customer deposits to become less reliant on the more volatile, expensive wholesale funding markets.
Okay, to really bring this financial story together, let's look back over the past decade using the summary tables in the report. What does Table 1, the 10-year financial summary, really show us about the journey to this pivot?
Table 1 gives great context. You can see total revenue growing pretty steadily from $24 billion back in 2015 up to nearly $34 billion, 33.67B in 2024. So the top line has generally moved in the right direction.
But net income shows more bumps.
Exactly. Net income fluctuated more. It peaked at over $10 billion, 10.17B in 2022, then dipped significantly to $7.45 billion in 2023 that reflect those higher PCLs and tougher conditions before recovering somewhat to $7.89 billion in 2024.
And earnings per share, dividends.
Diluted EPS has also moved up over the decade, from $5.67 to $5.87, but with volatility mirroring net income. But dividends per share show that really impressive, consistent upward march from $2.84 in 2015 to $4.28 in 2024. Rain or shine, the dividend grew.
And the ROE line in that table really highlights the core issue, doesn't it?
It absolutely jumps out. You see ROE at a healthy 14.6% in 2015, then it drops to a low of 10.1% during the pandemic. 2020 bounces back strongly to 15.0% in 2021 with a recovery, but then settles back down to that 11.3% level in 2024.
That volatility and the recent lag compared to historical levels and peers perfectly illustrates the profitability challenge the new strategy needs to fix.
But the capital ratio, CET1, stayed strong throughout. Rock solid. Consistently above 10%, often well above, throughout the entire decade. That underlines the bank's financial stability, even when profitability fluctuated.
Okay, now Table 2 breaks down the adjusted net income by business segment. How does that highlight the different performance drivers?
Table 2 is really revealing. It clearly shows Canadian banking as the consistent engine. Its adjusted net income grew steadily, for example, from $3.85 billion in 2021 to nearly $4.3 billion. 4.277B in 2024. Reliable, growing contribution.
Contrasted with international banking.
Big contrast. International banking shows much more volatility and generally lower absolute contribution, despite its scale. Net income there was $1.7 billion in 2021, jumped to almost $2.6 billion in 2022, stayed flat in 2023, then rose to $2.86 billion in 2024. You can see the swings, and importantly, its lower return on capital dragged down the overall bank ROE.
And global wealth management.
That segment shows that nice, steady growth characteristic of fee-based businesses. For example, growing from $1.56 billion to $1.61 billion between 2021 and 2024. Consistent. So this historical segment view perfectly illustrates the rationale. Bolster the reliable Canadian engine, leverage the stable wealth growth, and fix the volatile, lower-return international piece through strategic refocusing.
The numbers absolutely tell the story and set the mandate for this pivot. Very clear. Okay, we've covered the history, the pivot strategy, the industry context, and the financials. Now, part 5, risks, valuation, and what to monitor next. Because no big strategic shift is risk-free, right? There are always headwinds.
Absolutely not risk-free. While the potential upside from a successful pivot is clear, it's crucial to acknowledge the risks. First and foremost, credit risk.
Where specifically?
Two main areas. Domestically, Scotiabank has significant exposure to Canadian households, particularly through mortgages, and Canadian consumers are quite leveraged. A sharp economic downturn or a major housing correction could lead to higher loan losses. Internationally, the risk is different, but also significant economic and political volatility in those Latin American markets. Currency swings, policy changes can impact borrowers' ability to repay very quickly.
And interest rates remain a key risk, even if they've helped margins recently.
Definitely. Interest rate risk is always there. As we said, it's a double-edged sword. Rates falling rapidly could compress margins again. Rates staying high for longer might boost margins short-term, but could eventually strain borrowers even more, leading to higher credit losses later. It's a constant sensitivity.
And the regulatory environment isn't getting any easier.
No, regulatory and compliance risks are ongoing and seem to only increase. Those evolving OSFI rules on climate, resilience, cybersecurity, open banking, they all mean higher costs, more investment, and the potential for significant penalties or reputational damage if something goes wrong.
Plus risks specific to their international footprint.
Right, geographic and currency risk. Even with the pivot, a chunk of earnings still comes from outside Canada, mainly the Pacific Alliance. So they're exposed to those economic cycles, political events, and the risk of earnings translating back into fewer Canadian dollars if currencies move against them.
Okay, those are mostly external or macro risks. What about the risk of the pivot itself? The execution, that feels like the big one here.
It's arguably the most significant risk right now, execution risk. This is a major strategic overhaul, and they're still in the early innings. Success really hinges on integrating this North American strategy effectively. Can they realize the expected benefits and synergies from the Key Corp investment? Can they successfully improve the profitability of the international assets they do keep? These are huge operational challenges. Delivering on a plan this ambitious is never guaranteed.
And fintech competition isn't going away?
Not at all. Competition from fintech remains a persistent threat. Those agile players will keep chipping away at profitable niches, putting pressure on margins, and forcing Scotiabank to keep investing heavily in technology just to keep pace.
Okay, given all these risks and the bank's track record, how is the market valuing Scotiabank now? Does the current valuation reflect the risks, or is there maybe an opportunity if you believe in the pivot?
The current valuation definitely reflects the market pricing into that history of lower profitability and the perceived higher risk profile compared to its top Canadian peers. Looking at the metrics as of August 2025, the price to earnings, or PE ratio, was around 12.4x on a trailing basis.
How does that compare historically?
It's actually above its longer-term 10-year average, which was more like 10x to 11x, but it's still below the peaks it reached in better years. The price to book, or PB ratio, was about 1.33x. Again, that's above the lows seen since 2020, but significantly below the 1.5x to 2.0x multiples the stock sometimes commanded a decade ago when its ROE was higher.
And compared directly to peers, that valuation discount is still obvious.
Very obvious when you look at Table 3, the peer comparison. Scotiabank's PE around 12.4x and PB around 1.3x stand out against, say, RBC, which might trade closer to a 14x PE and a much higher 2.2x PB.
And that difference comes right back to ROE.
Directly. The market is essentially saying, you generate lower returns on equity, so we'll pay a lower multiple for your stock. It's a direct reflection. The whole investment case hinges on whether this new strategy can successfully close that ROE gap, which should lead to the valuation gap closing too.
Does the high dividend yield offer some support for the valuation?
It definitely provides support. That attractive yield, around 5.6%, offers a significant chunk of the total return for investors and acts as a cushion against stock price volatility, especially during this transition period. It puts something of a floor under the price.
And looking at ROE versus the cost of capital,
Right now, their recent ROE in the 11–12.5% range is just slightly above their estimated cost of equity, which might be around 9–11%. So they are creating economic value, but the spread is thinner than at higher ROE peers. The whole point of the strategy is to widen that spread, generate significantly more return than the capital costs.
could sum of the parts valuation suggest the stock is undervalued?
It's an interesting angle. A sum of the parts analysis, where you try to value each business segment separately, might suggest the market is putting too harsh a discount on the international banking segment, or perhaps not fully valuing the stable earnings from Canadian banking and wealth management. It implies that if the company were broken up, or if the market starts valuing the parts more appropriately as the strategy progresses, the consolidated stock price could be higher. It points to potential upside if the pivot works.
Okay, so if we're following this fascinating transformation story, what are the absolute key metrics we as listeners should keep our eyes on over the next few quarters and years to judge if this pivot is actually working?
There are a few absolutely critical ones. Number one, without a doubt, international segment return on equity, ROE. Sustained, meaningful improvement here is non-negotiable for closing that valuation gap. It's the acid test.
Okay, ROE for international. What else?
Second, watch Canadian banking primary client growth. Is that strategy to attract and deepen relationships with those highly profitable domestic clients actually gaining traction? That's key for the domestic growth engine and improving the funding mix.
And for overall financial health?
Keep an eye on net interest margin, NIM trends. Are they successfully managing funding costs and lending spreads, especially as the deposit mix hopefully improves? Also, watch provision for credit losses, PCL, as a percentage of loans. Any unexpected spike here could signal deteriorating credit quality and eat into profits.
Efficiency is key too, right?
Absolutely. Track operating leverage. Is revenue growing faster than expenses? Consistent positive operating leverage shows disciplined cost control and scalability, crucial for improving profitability. And of course, capital ratios, CET1, need to stay strong to provide that foundation of stability and flexibility.
One more. Digital.
Yes, digital adoption rates. Are customers actually using the digital channels more? Are digital sales increasing? This gauges the success of those huge digital transformation investments, which are vital for both future efficiency and customer experience. These metrics, taken together, will really tell the story of whether Scotiabank's bold pivot is delivering on its promise.
Wow. What an incredibly detailed deep dive into Scotiabank's journey. We've really explored that core tension, haven't we? This bold move away from being Canada's most international bank towards this focused North American corridor strategy.
It's a huge undertaking, shedding some of that historical identity, aiming for higher, more stable returns. It really shows that even the biggest, most established institutions sometimes need to fundamentally rethink their direction.
And the potential is definitely there if they execute well. That KeyCorp investment looks like a smart way into the U.S., and that focus on primary clients in Canada makes a lot of sense. Success could really lead to a re-rating of the stock and better profitability.
It could. The execution is key, though. Lots of moving parts.
Absolutely. It leaves you with a really provocative thought, doesn't it? What does it mean for the whole Canadian financial scene if one of its oldest, biggest players successfully reinvents itself like this, prioritizing regional integration over that older model of broad global reach?
Yeah, and how might that influence other global banks?
Hmm.
Are we seeing a broader trend where companies reevaluate what international means, focusing more on integrated economic blocks like North America, rather than just planting flags everywhere?
Yeah.
Especially given the geopolitical shifts and supply chain changes happening now.
It forces a reevaluation of global strategy in the 21st century. It's not just Scotiabank's story, it's a reflection of bigger changes.
Precisely. It's a fascinating case study in strategic adaptation for any large organization navigating today's complex world. Their chosen path signals that agility and rethinking core strengths are vital, even in traditional industries.
Couldn't agree more. Keep watching those key metrics we discussed. The next few years are going to tell a truly fascinating story of strategy, execution, and how the market reacts. We'll definitely be revisiting this.
Looking forward to it.
Until next time, stay curious.